How are you doing? This is David W. Williams, also known as Diamond Dave. What we're going to talk about today is how to manage trades and not lose all of your money. This is going to be a good video for people that want to understand how can I manage trades and not lose all of my money while I'm trying to trade. This is not going to be financial advice. It's going to be based on my own experience as a trader. And this won't just relate to options traders. This can relate to anybody that is involved in any market, in my opinion. And then what we're also going to do at the end of this particular broadcast is we're going to do a little bit of a Q&A in which you can kind of ask questions about anything that you want to ask about the options market. And then we're going to go ahead and close out. So really quickly, we're going to go to the sponsor of the show. We're going to do that promo, and then we're going to get right back to the content. Let me get that out, and I'll be right back.
Here is a testimonial for the highest paid part-time job in the world from Terrence Russell Jr. I stumbled upon Dave's video for beginner options traders in March 2022 and was instantly hooked. After a few weeks I finally decided to purchase the course, and yes, I was skeptical, but that's okay. I am here to tell you the course is worth every penny. You could watch all of his YouTube videos but save yourself a lot of time and invest in your education. If you take this seriously, you won't regret it.
Okay, so that's out of the way. And I want to just reiterate to you, we're getting ready to close the first quarter of the year. Many people had really high goals and high resolutions for what they were going to do about this year. If you haven't started or really gotten into accomplishing those goals, you want to kind of ask yourself, what about this year is going to be different than last year, except the fact that you're going to be older? Now, let's talk about how to manage trades and not lose all your money. The reason why this is a good topic is because many people come into this trading space and they yo-yo, right? They make money, they lose money, they make money, they lose money, and they can never really kind of figure out how to really get on any kind of path to stability. And what I've learned over my own experience is this kind of key point, right? Which is this: risk management is always going to be more important than making money. And because I don't think people really understand and have been taught properly how to evaluate risk in their own life, they don't necessarily always understand risk management. Therefore, when they're looking at a situation that's market-based, they don't know how to estimate the risk that they're involved in. They don't have a metric they can put around it. They don't have a way of quantifying it. They kind of always go off what somebody else tells them. So if somebody else that they believe or trust tells them that it's not risky, then they believe it. If somebody that they believe and trust tell them that it is risky, then they believe it. And then what they also look for people to do is to confirm their own beliefs around risk. Therefore, if I believe that opening up a business is very, very risky, I look for people to tell me that, because that's what I believe. So that's why when you get the people that say, well, I like what this person says, what they mean is that this person agrees with what the story is already going on inside my mind. If I believe that me engaging in this activity is not risky, I'm looking for somebody to tell me the same thing. And then their life is going to kind of be based on that. If you ask them, how do you quantify risk? Using some type of model, some type of metric, yada, 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 they can't figure it out because they never built a model for it. Therefore, they don't know how to do it. And then therefore, when they go into any kind of market-based scenario, they will struggle because they don't have a way of evaluating risk on their own. And they don't have so much money that they can pay people to evaluate risk for them. And they understand what that means when that person tells them that. Right? This is why they struggle in the markets. Got nothing to do with the markets, got nothing to do with anything else. Is because they don't have a model to evaluate risk. They never built one out. They don't know how to do it. So they go by what other people tell them. In my opinion, what I've taught people over the past few years is that risk management is always more important than making money. And that's something that I want to really encourage people to really start to evaluate. If you manage the risk properly, normally the money will show up. But if you're not managing the risk, it can be very difficult to maintain the money that you make in the market. Okay. And so I've made a lot of mistakes in the market because my risk management was not at the level that it needed to be. And that's something I had to really work on, was managing the risk associated with what I'm doing. So we're going to go into this trade real quick because I want to kind of show you what I'm talking about. So here's a trade on Tesla. It was a June 21st, 2024, 190 put. So I took a 26% loss on the trade. I entered it Tuesday, February 13th, and I exited Thursday, February 15th. So I wasn't really in the trade that long, but I wasn't going to wait. I had a 30% stop. I wasn't going to wait till I got to the 30. I said, I'm at 26. That's pretty much 30. Let me go ahead and get out. Now, the trade went back in my favor the next Monday. So I probably could have been positive on the trade. I forgot what it closed. I think it closed the day at 197. I'm sorry. I think it closed the day was at 197. I think it closed the day at 197. I'm sorry. However, once I hit close to my stop, I got out. Because why? That was the risk parameter. There was no guarantee that Monday things were going to go in my favor. Monday things could have kept going against me. Right? Therefore, the most prudent thing to do, in my opinion, was to get out of the trade and then reassess my narrative around this particular ticker, because I just could be early on the trade. And one thing about trading options is because it's an expiring security, something that you have to be worried about is how the Greeks are going against you based on the, I would call the decaying of this particular security over time. So therefore, even though there was a lot of time on this, Tesla's a relatively volatile ticker. So then therefore, the IV, with it moving around so much, can decay or either build up more premium. So it kind of depends on what side of the trade that you're on. But Tesla, even now, is still a relatively volatile ticker, not as volatile as it used to be. Therefore, in this scenario, in my opinion, the best thing for me to do was exit, maintain my capital that I can maintain, as opposed to sitting in the trade, hoping that it went my way. Right? So even though I had a lot of theta, which is months on the trade, in my opinion, the most prudent thing to do was to get out. And so that's something that you want to ask yourself. So the question you want to say is that, how do you react when a trade goes against you? Right? How do you react when a trade goes against you? When you're in a trade, when you're in any market-based scenario, whether it's you buy a house, you buy a car thinking that you're going to sell it, you go try to do Amazon FBA, you try to buy stuff at garage sales and at storage units with the hope that you can sell it, and then you realize that how you perceive the value of this particular asset of security, the market now has changed its perception of that value. How do you react now? Well, let me ask you a question. Do you have a framework of how you're supposed to react when things go against you? I'm gonna repeat myself. Do you have a framework of how you're going to react when things go against you? Have you thought about it? Right? That's in any scenario. So this is why a lot of people struggle at buying and holding stocks, because they don't have a framework of how they're going to react when the market sells off like it did in 2022 and they lose like 16% on their 401k. They haven't created a framework for that because they're dependent upon somebody else to tell them how to trade, or they're dependent on somebody else to tell them how to invest. So you're dealing with a financial planner, and the financial planner tell you just buy index. Well, has a financial planner created a framework for you when the market sells off 16% on the year? Because that can happen. Or you can get a scenario that happened in like 07, 08, where your 401k essentially goes underwater. What's the framework for that? Because if you're paying a person to tell you how to invest, you probably don't know, because you're paying somebody to tell you how to invest, that you need a framework for when everything goes bad on you. Because that can happen. You're inside a market and you can't control the market. Right? Therefore, you want to kind of ask yourself, what models do you have in your life for when things go against you, you know what you need to do? Because what most people do is they just react. Then they react, then they look for somebody else to blame. And so that's what they look for. They look for somebody that's going to connect with their reaction to something going wrong. And then they look for somebody that's going to give them somebody to blame. Right? But there's nobody to blame for what happened here except me, because I was the one that put myself in this trade. You understand me? Didn't nobody put me in this position but myself. I chose this particular strike price. I chose this particular situation. I created the narrative in my mind around what I wanted to do, and then I clicked the buy button. So there's nobody else to look at when it goes bad except myself. I can't blame Elon Musk. I can't blame the market makers or Citadel or none of those people. They don't have nothing to do with this, because I was a person that chose to get in this situation, right? And so that's something I want to really ask you, is that, do you have a framework around what you're doing when things go bad, to when things go bad, you go to the framework? Or do you just react to it and then got to try to figure something out on the fly? Or you one of those people, and there's a lot of them on social media, to where you look for somebody that you can connect with on why things went bad, and then you look for somebody that you can connect with on who you want to blame around why things went bad. And then once that emotional release is over, you reset and you go right into the next situation. If things go bad, you just go through the same process again. And you'll do this for the rest of your life. So that's something that you want to ask yourself. What is your reaction when a trade goes against you? Have you observed how you react to it? And then how can you react to it in a way in which it puts yourself in the best position to have longevity? Because let me tell you a secret about the markets. The goal is to hang around, right? That's the goal. If you hang around long enough, normally you'll be able to be successful. What hurts a lot of people is they can't hang around long enough to be successful. That's pretty much any market, because what other people are trying to do is force you out of the market. Because why? They know if you hang around long enough, you'll be successful. That's how markets function. So the goal of your competitors is to run you out of the market by whatever they got to do. Right? I was watching a documentary earlier today about South Africa. And there's an issue with the taxi businesses where they're competitors against each other. The taxi business is real big. It's not like taxis like vans. They're like, I don't know, they're not Sprinter vans, but they're like vans, right? That they use in South Africa to drive people around. So what they do is they try to kill each other. So the taxi chiefs or barons or whatever you want to call them that own the companies, they hire assassins to try to knock off the other chief or baron, right? Because if we can get rid of him, we can just take the whole market in this particular area. So you got to try to figure out how to hang around, which means what? You got to hire people to protect you. So both the barons got guns and they running around with guys with guns. They got a full security team, because in most markets, if you can hang around long enough, you have some level of success, right? Now you got to figure out how to have success, but you can't have any success if you're not in the market, right? Therefore, if you can sit in the market long enough and learn what's actually going on, you normally can try to figure out a way to get successful. So the goal of your competitors is to force you out of the market. Therefore, what you want to figure out is, if you enter into a market, is how do I stay in here long enough until I can figure out how to get successful? That's why capital thing is so important, because what does capital allow people to do? It allows them to hang around long enough to figure it out. If you lack the capital, you can't hang around long enough to figure it out. You get forced out because of lack of capitalization. This is why capital is so important. These are the kind of questions you want to ask yourself, but you can't if you're still at a point intellectually in this space to where I go to X person and X person tells me everything to do, and I have no idea, right, what is even going on. So then when things go wrong, I don't even know what questions to ask. Right? That's going to be the issue. But that's what most people deal with. They've been sold that format. They're going to a guy who's made himself millions, right, telling people to save money, but he's made himself wealthy investing. They go to him to learn how to save money, but he never going to tell you how to invest, because he don't make his money doing that. He made his money telling you to save your money. But then if something goes bad, you can't get back on the phone to talk to him. Let's go to the next one. So, do you know your exit before you go into a situation? Okay. So this is something I taught people in my course, that it was always interesting to me that we produce so many people in this society, and they don't know the answer to these questions in relationship to capital. Before you go into a situation, do you know where you're going to exit at? Or are you waiting to see what's going to go? Like, are you hoping that something goes your way? Are you waiting to see what doesn't go your way? Do you go in knowing what you're looking to get out of the situation? Right? And this is where a lot of people struggle. It's a lack of exposure and education to this type of decision making. Right? Before you enter into, let's say I buy a home and I'm going to do a fix and flip. Well, how much money do you want to make off the house? Do you know? Or are you just hoping that everything goes right? Or do you just want to say, hey, I flipped the house? Well, what are you looking to get off of it? Because based on what you're looking to get off of it, don't the numbers have to work to make it worth your while? Or let's say you're getting ready to buy a car and you want to resell it at a later date. What are you looking to make off this car? Do you know? Or are you hoping that if I buy the car and maybe do some detailing, I can maybe sell it for more than what I bought it for? Do you have a number that you're looking to make off the car? Do you know? Or are you just hoping? Do you know your exit before you go into a situation, on the good side and the downside? So before I go into a trade, I already know, first I know where I'm going to exit if things go against me. Then I also know where I'm going to exit if things go well for me. The same thing if I was to run a business. If somebody came to me and said, David, I'll buy your business from you. If they gave me a certain kind of number, I'm going to sell the business. Why? Because that's my exit, right? I already know what my exit is at. So if the numbers speaks to a certain thing, that's my exit. I know where I'm looking to get out of a situation. Most people don't. They just hang around until the situation just falls apart. Then they look to get out, right? And that's something that you want to understand. Do you know where your exit is before you leave? The next question we want to talk about, how do you adjust when things go against you? If things are going against you, what's your adjustment? Right. And I have some more examples I'm going to go into with trades, but I just kind of want to break these points down. When things go against you, how do you adjust? What's your adjustment? Do you have a structure that allows you to adjust? If you lose your job tomorrow, what's your plan? Do you know? Do you have a contract? If you don't, that means you can be fired. If you lose your job tomorrow, what do you do? Right. And I'm not saying that you got to be perfect in this, right? Everybody got holes in what they're doing. But do you have any type of structure based around your life? Have you spoken to people about, hey, if this happens, this is what I want you to do? Is there anything in place? Or is it just all up in the air? When things go against you, what you going to do? Do you know? Or are you guessing? Therefore, before I go into a trade, I know what I'm going to do if things go against me. I don't care what anybody else does. I know what I'm going to do because it's my money and I'm managing the capital. So it's my job to manage the risk associated with my activity, right? So I have to come in with a plan and knowing what I'm going to do. Okay. Let's go into another trade, right? So let me show you another example. So here's a trade on CAR, and it's going to kind of reiterate some of the things that we talked about. So looking at this trade, you're going to notice some people will, some people won't. We have a 165 put and an exit at a 155 put. Now, the reason why that took place is because Avis Sakar did a $10 dividend. And as them doing that $10 dividend, it adjusted the stock and it also adjusted the strike price on the option. It's real weird, right? So what happened is I bought a 165 and it got changed to a 155, right? I didn't necessarily agree with that, but there's nothing I can do about it, okay? Because I don't control the market. But I'm in this particular play and I exited on Friday. So I bought it in December, January, February, right? And I exited on a Friday. I was at 343. Now, if I would have waited until probably Tuesday, I probably could have got maybe 400% out of it. But the question is this: do you know your exit before you go into a situation? Why would I risk the money I've already made when I can exit now with a 300% profit? Right? Because if I only run one trade this year, my P&L says I'm up 343% for the year. If I just run one trade and I just walk away from the market for the rest of the year. Okay? So this is what I want you to understand is that you have to know your exit before you go into a situation. And because I know my exit, I'm not trying to make this turn into a 500 or 1,000% return because I know what my exit is. And I know that, you know what, this particular stock is so volatile. The spreads on this particular stock are wider than what I would normally go into. I don't want to wait until it turns around and then try to exit because the spreads are so wide. If I try to wait until it turns around and then look to exit, that could really hurt my gains because of how wide the spreads are. See, with Apple or Facebook or something like that, you could play SPY. You could do that type of stuff. You could wait till it starts to turn against you to exit because the spreads are already so tight. You're looking at 1% and 2% difference between the bid and the ask on the spread. With this, it's not going to be like that. Therefore, to me, it didn't make a lot of sense on Friday to try to get another, 40, 50% out on Monday or Tuesday, even though that happened because on Monday and Tuesday, it went to about $100, right? But like I said, the goal is to manage the risk, not just try to make the money. Okay? And so I've been trading long enough to where the numbers really don't move me like it moves somebody else. Because to me, it's just numbers. What I'm more focused on is, am I sticking to my plan? Am I sticking to what I said I was going to do? Am I sticking to my structure? Because to me, that's what's going to allow me to have long-term longevity. So one thing I'm going to try to do next quarter is put out a basic investing course. And it's going to really be about basic portfolio management and just sticking to that, as opposed to chasing stuff. Because most of the time, if you're going to, and I've seen in my own experience, if you're going to invest long term, the people that are successful long term is the people that stick to their portfolio management. They don't chase stuff. So if you already don't have NVIDIA, it may not be the time to start looking to buy it, because why? The prices run up so much, you buying it at the top. But a lot of people are going to chase it because they've seen the run that it's been on. But now you got to start looking at the fact that you may be buying the top, right? Probably should have thought about it buying NVIDIA 2 years ago, right? But there's going to be another NVIDIA, because NVIDIA is taking a role that Tesla took 4 years ago. So the market keeps producing these type of plays. So that's what I want you to understand, knowing your exit before you go into the situation. So let me give you another example, right? Here's another play on Avis. So it's a 160 put, and I exited at, it was turned into a 150. We talked about it again. They adjusted the prices. So bought it in October, right? And then sold it in February. So held it a lot longer. Okay. It's a 64% ROI. So if I would have waited until probably Tuesday, I probably could have got 100% out of this. But like, again, I'm at 64%. So why should I wait? Right now, to me, looking back at this trade, I don't like the trade, because I feel like the capital that I put in, the return wasn't worth it. Right. I feel like the capital that I put in up front, the return really wasn't worth it. From a risk management standpoint, I think there could have been better opportunities here. But what happened is I came into this play in October, and a lot happened to this ticker in between. And so there was a run up on the ticker, almost up to $200, that changed the premiums a lot. Then it ran back down. But because I bought it so early, I had to withstand that. That's why this 64%, this trade should have been more like this trade. Because if you look at the strikes, it's only $5 in between each strike. But if you look at the dates in which I bought them, that's the difference, right? The premiums had changed in between those dates. The reason why I kept adding on, because I was 100% confident it couldn't support those prices, right? Then you had the news about the $10 dividend. It ran up, but the premiums had changed from when I had bought it in October, right? But I added on in December, okay? Because my model was based around this stock price starting to deflate once they came into earnings. But again, I could have held on to this because it don't expire until May, which means I got February, March, and May. Almost got a little over 60 days left, right? Sold on the 16th, it don't expire till May. So I got 60 days left on the play. I could have held a little bit longer, right? Maybe could have seen that, will they have another earnings before I sell? I forgot when their earnings is. It will be sometime in May, probably. But why would I walk away from 64% ROI? Right? And so that's what I want you to understand, is that most people fail in this market because their risk management is terrible, not because they don't understand how to trade. Trading is easy. Managing the capital is what's difficult for a lot of people, because they don't know how to do it. They don't know how to create a framework around it, because they don't do it in their own life. So what most people do is they give their money to somebody else to manage it. They don't know what framework their money's being managed under. What's the framework? I have no idea. Is it risk adjusted? What is risk adjusted? What does that mean? Well, what's the hurdle rate for you giving somebody your money to adjust? I don't know what a hurdle rate means. I just know they told me if I put my money into a 401k, after 30 years, I should have $1 million. So I'm just hooked on the million. That's how most people function, right? Without realizing that you can maybe be more successful if you take some control over what you're doing. But then you got to be willing to learn what you need to do. But you have a whole industry that's based on keeping you ignorant, because that's how they make their money, right? You got car mechanics on YouTube that show you everything that they do, because they know most people don't want to do it, because you got to actually get up under the hood of a car. Most people in the financial space don't want to teach you what they do, because why? It's easier for you to do that than learn how to fix a car, because fixing a car is dangerous. You can hurt yourself. They're not going to teach you, in my opinion, because they often don't want you to do their job. AI is going to change a lot of that. We're talking to somebody today about how AI is going to change tax prep. AI is going to change a lot of that. But what I want you to understand is that when you have a framework that you're operating under, it allows you to manage the risk a lot better, as long as you stick to the framework. So the next question you want to ask yourself is that, Are you fearful in real life when it comes to financial situations, right? In real life financial situations, are you fearful? Do you have a hesitancy to enter into them? There's a really good story about, and I'm not going to say he was fearful, but he was ignorant. Y'all may know Anton Walker used to play ball for the Celtics and how he lost pretty much all his money that he made playing ball. He had real big contracts. Okay. One of the reasons why he lost a lot of his money is because he gave his money to other people to invest for him. And he had no idea what was going on. It wasn't because he spent all his money. You can't spend that kind of money just buying stuff. People got to be putting your money in stuff, and the money gets effed off behind what they're doing. So he gave his money to a lot of people, put his money into a lot of real estate. It crashed because of the real estate crisis in the mid 2000s, and he ended up broke. That's how it goes when you don't know what to do with your money. And so many people, because they're fearful of financial situations, they think the most appropriate thing to do is just hand all their money to somebody else. I'm not a believer in that. Do I believe in counsel and consulting? Yeah, but I don't just believe in you just handing your money to somebody else and you have no idea what's going on with your money. That's how a lot of people get robbed. Okay. And that's what I want you to really understand is that when you don't kind of want to deal with these issues, it could put you in a position to be vulnerable, but they're always going to present to you the person that handed their money to the industry and it worked out for them. That's the best case scenario. They won't present to you the people that handed their money to the industry and it didn't work out for them. And if it doesn't work out for you, what can those people do for you? Right? So, I would call up my financial advisor right now today and say, if the market closes down on the year by 15%, what happens? Like, what do we do? Do we have a framework for that? What's our defense against the market going down? Because you got to have an offense and a defense in the market, right? So that's why you see things like tail risk funds become big, because people that got a lot of money, they're worried about if the market crashes, what am I going to lose? So they invest in what we call tail risk funds that invest in convexity and things of that nature, right? But I want you to understand, if you got a financial advisor, you got people that's telling you what to do with your money, especially people that are investing on your behalf, right? If the market goes down by 15% next year, what's the plan? Most of them going to tell you just keep investing. That's their plan. Because why? They get paid on AUM. So then what they get paid is off the pool of capital that you're investing. They don't get paid to come up with a strategy. That's not what they get paid for. And a strategy doesn't mean you're trading in and out of the market. It means that you have a strategy of what you're going to do if the market goes under. What are we going to do? Just like you should have a strategy for what you're going to do if your car breaks down. Oh, I got a strategy for what I do if I get a hole in my roof, or if the plumbing goes bad in the house. What do I do? As opposed to just waiting for it to happen, and then now you got to react to it. Now you got to scramble, right? And that's why a lot of people find themselves without having the financial ability to handle these things, because they ignore it because they don't want to face a financial situation. So they just hope it doesn't happen, right? So that's pretty much going to be it. That's how I manage risk. I come into the situation with an exit plan. I know what I'm looking for to get out of the trade. And I learned over time to not risk gains trying to get an extra 10, 15, 20%, especially in a high risk situation. CAR is a pro ticker. It's not a ticker for rookies, right? It's a pro ticker. I've been trading a long time. I kind of know how to manage this situation because I've looked at it a long time. So I know what situation I'm in. I know when it's time for me to get out, right? It's not time to hang out. It's time to get out, right? Most rookies will hang out and get caught, okay? So that's what I want you to understand. That's pretty much going to be it. It's not going to be long-winded about it. So what I'm going to do is open up the floor to any options, Q&A, any questions about options, anything you want to talk about. I haven't done one of these in a long time. Let me know while I'm up here, and we can go ahead and get into it. So Robbie Rob says, are there any rookie-friendly tickers I would recommend? I can't recommend anything because I don't know your situation. So what I would ask you to do, Robbie Rob, is to ask yourself, like, what's your capital? What risk are you looking to take? What type of stuff are you interested in? Like you got to kind of know yourself as a trader and have a basic understanding of like what situation kind of works best for you, how your life is set up. So I couldn't recommend anything off the top because I don't know how your life is set up, right? Your life may be set up for you to trade indexes better than you to trade individual tickers. It all depends on your situation. So that's something I wouldn't be able to tell you off the top of the head. What's a rookie-friendly ticker? But I do teach in the course, if you're not a pro and you haven't been doing this for a long time, what you need to stay away from. So I talk about tight spreads, right? Tickers that are not illiquid, because illiquid tickers with wide spreads, I wouldn't recommend that anybody that don't have an extensive amount of experience doing that, right? That's just my personal opinion. So Mr. Russell says, how do I feel about in the money versus at the money contracts or smaller accounts? It depends on the situation. What's the trading situation? But I always recommend that people try to buy as close to in the money as possible, right? But at the money is really not that difference in the money. And if you get the direction that you want, you'll be in the money soon. But I try to really encourage people to be very wary of out of the money, because those contracts are often priced cheaply for a reason. But it depends. I was looking at out of the money calls on the SPY earlier this year. Those calls would be very close to being in the money right now because of the way the SPY ran. So that's why it's a case-by-case situation. So I think, Mr. Russell, what really benefits people is to get experience, to really learn the ticker that you're trading, because every ticker can trade differently. And so the movement on that ticker can be different. So if I'm looking at the SPY, I can maybe buy 2-year leaps way out of the money and to be very, very cheap. And as long as there's not a financial crisis, those tickers, those options could be in the money within 6 months to a year, as long as we don't have a financial crisis, right? Because the market is designed to keep going up. And we've seen the SPY pretty much go up since the top of the year. But if I'm looking at another individualized ticker, it may not be a good trade, in my opinion, to buy that far out of the money, because the likelihood of gaining that by expiration, or gaining half of it by expiration, could be extremely low. But it can depend. I was talking to somebody today. I don't know if you know about Grant's Interest Rate Observer, and they were talking about buying calls on something that could essentially track or mimic interest rates, and buying out of the money calls and taking advantage of the convexity, which really means that you're going to get a volatility pull if they raise the rate again. And so those contracts could go from being extremely, extremely inexpensive to having a good amount of value in a relatively short amount of time, right? So that's kind of how I will look at it. But that's a great question. What do I listen for on earnings calls? It depends on what I'm coming in listening for, right? So when I'm coming into the earnings call, I already have certain things that I'm looking for. So I'm not listening for anything specific that I can tell you up front. It's what am I coming into the call listening for from the gate. So let's say I was a reporter, and I'm going to listen to like the president's, what do you call it? It's not Face the Nation. It's when they speak to the whole country. I forgot what that particular thing is called for the president. I'm coming in as a reporter looking for the president to say certain things. That's what I'm looking for. But it's not, I'm looking for something in general. My mouse. Uh-oh. Let me see. Okay, my bad. So Mr. Russell says, should we take on more risk because we have smaller accounts? I've been trading with $1,000. So let me know you can hear me. So how do you ask for more risk? So what do you mean by more risk? And what, how do I say? What I would ask, what are you trading? Then what do you mean about more risk? What are you trading? What's your position size? And if you've been trading with $1,000, how long have you been trading with $1,000? And have you had the ability to multiply that account? Right? So initially, you may be taking on more risk, but the goal is to expand the account to where you can take on less and less risk with every trade. Right? But I would have to ask, like, what are you trading? What's your position size? Things of that nature. So when I first, and I need to make an adjustment. So when I first started teaching the course, this was like 2019, I was telling people like $250 to start an account. The issue is inflation has raised contract prices. So contract prices are a lot more expensive now than what they were in 2019. So that may have to go up, because when I first started trading, I was able to buy $25 and $30 contracts on banks, right? And get like in the money or at the money contracts on banks. But this was like, 2014, maybe 2015 when I was doing that. Things have gone up. So, but I would ask you, like, what are you trading? What's your position size? And I would encourage people to really dedicate themselves to really finding a ticket that works for them based on their budget. I can trade with 1,000, but I would first look for things that fit within me only spending maybe 10, 15 to 20% on a contract. That's what I would do. And that may end up being indexes, but that's what I would look for. Because to me, 1,000 to me personally is more than enough to do what you need to do. But that's just me personally. That's a great question, though. So did IV Crush mess with any of your gains after Avis earnings? No, and not really, because it just kept selling off. So there was no crush, right? Because I was already in the contract, right? So there was no crush. What the IV Crush was on was this one. This was the IV Crush, because when I bought it, it went from, I don't know what price it was at. It went back up to 200. Then it went from the 200 all the way back down, right? So because I didn't get really IV Crush, because most IV Crush is going to come around earnings. It was bought so far out ahead of earnings. But the IV is going to be high now because of how it's been selling off. Yeah, Mr. State of the Union, State of the Union. I forgot about that. Yeah, I don't know what happened to my computer. The sound just dropped off. So Rob says, I get 90% of my market information, earnings call, Wall Street Journal, Financial Times. No, it's not. If that's working for you, it's nothing that you're missing, unless you realize that you're missing something. So based on your setup, there's nothing that you're missing until you ask yourself, am I missing something? Then you may be able to find what else are you missing. So if that's your structure, then you're not missing nothing until you decide that you need to add something else into your structure, right? So at least you got a framework of what you're operating under. So Mr. Jade, I'm sorry, I don't know what IWM is. So tell me when you get a chance, tell me what IWM is. So Cedric Webb says, what is the main purpose of reading the SEC filings? So I can understand what's going on with the company, because they got to file it. So they got to file 10Ks, 8Ks. They have to file because they're publicly owned companies, anything going on in the company. Therefore, I would rather read it directly from the horse's mouth than wait for the financial news to tell me, because they may not report it, right? But if there's something going on in that company, they make any changes, they have to report it by law, right? So that's something that I do is I can get, you can RSS feed the SEC, where anything about a company, you should be able to get like a prompt on your computer that is coming up. But all you got to do is just check it so often, and you'll be able to see. So like Avis just did I think they did debt consolidation and then bought another debt instrument. They got to file that. You got to file everything with a publicly owned company, because you got to let your investors know what you got, what you're going on. So that's why I read it. And then I've also found, and I explained in the lockup course, the benefit of reading the SEC, because all the information around a company when it IPOs is in the SEC filings. So I would prefer to read it than to let the financial media, especially television, put their spin on it, because people got to understand something. If you're running a financial news show, nobody comes on your show if you bash companies all day. Therefore, you got to be positive on companies, because no CEO is going to come on your show if all you do is bash companies. So the financial, the actual people that do like the TV shows and the internet shows, they can't really tell you what's really going on in the company, because they'll never get anybody else on their show. So they don't really have a financial incentive to really tell you what's going on with a company. But you can figure that out if you read their filings, because they got to state it. So Ms. Ty says, compared to the premiums on some of the popular tickers, you can still find something affordable in bank stocks in a 250 account. I appreciate it. I'm going to do something this year. I got to just put it together on like how to get on FinViz and look for companies. because that's really how I do it. I'll get on FinViz and just look at stuff. And FinViz is free, you know? So it's free software for you just to look, but it just takes doing research. And it may take, so I'll show you at probably the maybe 6-month period how much money I made on Avis. My goal on Avis is to make more money on Avis than somebody that's probably made working all year, the average American. But I won't have to work the same amount of hours that the average American has to work. So let's say the average American works 40 hours a year, right? So let's say 40 hours a week times 52. So what's that? I got my calculator right. That's 2,000 hours, 2,080 hours, right? And they're going to take some time off, right? But if I can make what a person makes working all year trading, and I may only put in, let's say 200 hours, I'm up for the year. I'm still up. But there was a process to get to that point. So I just think a lot of people may struggle with not wanting to put the time in. And I'm not talking about anybody personally, but not wanting to put that time in. And I was talking to somebody about this the other day, which is why I think a lot of people run the technical, but you got to do the same thing in technical. You got to look at them charts over and over and over and over and over and over again till they starts to make sense to you, because you're looking at pattern recognition. And a lot of people struggle at pattern recognition. They just don't know that yet. But I'm glad you told me that. But I'm going to probably try to do something to where I'm going to show people like how to use FinViz to look at tickers, because that's something I use a lot. And it's a free site. I don't even know what you get if you use the paid part of it. But that's a great question. So how do I trade Avis with a small OI? Do the move in the direction you get make up for that? Yeah, so the volatility makes up for that, because Light, what we've seen over the past, well, ever since they reported earnings, their volume has been greater than normal, which is what I anticipated, right? And I talked about that on the live talk. When the institutions start looking to sell, the volume will be greater than normal, because you'll see them just dumping the stock, which is what we've seen with Avis. So I normally wouldn't trade it without me believing that there was a catalyst that was going to cause that increase in volume and also increase in volatility. So this ain't something, and I'm not trying to talk to you like any kind of way, but this ain't something I just pulled out of my hat. Like, I've been looking at this thing for a long time, and I felt like the situation was going to come to a head with these type of scenarios was going to happen, right? So I'm looking at a lot of tickers. If I don't see that they have that catalyst, I wouldn't do it. I would stay to something that's a lot more liquid. But I just felt like we talked about, this is going to come to a head. If you look at Avis on Webull, the actual ticker, you'll see like the past few days, it's just been massive selling, right? People just looking to get out of their position. So I think once the 13Fs get refiled, I don't know if we'll have Avis at 100% institutional ownership anymore, because somebody was looking to get out for that stock price to collapse like that. They were out, and the market makers was making them take lower and lower prices. And so it looked like it hit support at 100. We'll see what happens over the next 60 to 90 days, because they got another earnings coming out in another 90 days. Depending on how strong you believe in the trade, are you trading different expiration dates? You know, if I have more confidence, I'm going to trade longer expiration dates. If I'm more confident about a ticker, I'm going to trade a longer expiration date, because it costs more money to buy more time, right? So I would, if me personally, I'm not telling you what to do. If I'm more confident, I'm going to buy more time. Just like if I'm confident that the market is going to continue to expand, I will buy more time on leap contracts on the overall market, which is what I'm going to talk about. I'm trying to do a live event in April. I'm going to talk about that, because I'm so confident that the market is going to continue to expand. I would look at buying longer contracts on the overall market, because I believe the market is going to continue to expand. So I'm paying more money for more time, right? If I'm less confident, why would I buy more time and pay more money? Because I got to pay for the time, right? And even if I short it, I got to pay for carrying cost to the broker if I short it. So yeah, to me, the more confident I'm in, the more investment I'll be willing to make in the situation for me personally. would reading the SEC filings be a good start for beginners? So what information are you trying to get by reading the SEC filing? So what you're trying to do what by reading the SEC filings? The question I would ask you. What are you trying to accomplish? So I've been playing with different expiration dates and strike prices to figure out what works best for me or place of tickets I've been trading. Yeah, I mean, it depends on what you're trading, but I would also look at what's the IV, what's the delta, because the contract has to be priced to where it makes sense, in my opinion, it makes sense to enter into it. And then I believe that it's going to pay out. So like I would never buy contracts on SMCI because to me, where they're priced, it's impossible to win on the contract. They price those contracts so bad, I wouldn't even mess with it. Right? Short term or long term, it don't matter. Same thing with NVIDIA. To me, NVIDIA is just, I know people that had calls on NVIDIA still lost money this morning because of the way in which they priced the contract. Right? So that's not in the beginning course, but in the VIP, I really kind of went deep into the Greeks and kind of getting people to kind of understand the numbers sometimes got to make sense before you buy the contract. Because you want the numbers to get better, but the numbers can be so bad, it can be difficult for it to get better. But that's a good comment. So figuring out if I should place a call or put on the company. I mean, it could, I don't know. Because that still doesn't kind of tell me what information you're looking for. So like, what information do you need to know to whether or not you put a call or put on the company? What information is that? So again, I'm asking you, what information are you looking to get? Right. So with Avis, I wasn't trying to determine whether or not I should put a call or put on the company. I had specific information around the company that made me feel I could put a call or a put, but I wasn't looking to figure out whether I should put a call or put on the company. So I would ask you, what information are you looking to get? Yeah, I heard about that. Yeah, Roku falling, looking to fall even more after the Walmart and Vizio deal. Yeah, I told somebody in the Discord, Walmart should have bought Vizio a long time ago with all the TVs they sell. Like Walmart sells a ridiculous amount of TVs. That's a great partnership for them, right? So if I wouldn't have looked to buy it, I would have looked to buy into it, right? Because Walmart sells a ridiculous amount of TVs, like ridiculous amount of TVs that they sell. They might be the biggest TV seller in the country. So I would have bought somebody, right? And made money on both ends. Make money when it come out the door, you're getting paid twice. Do I look at volume when trading? I don't look at it when I'm trading. I look at it before I make the trade. But once I make the trade, I don't care about volume anymore. So that's a criteria before I make the trade. That's in the course, though, to look at volume, especially for beginners. So they're not in illiquid trades. But if you're trading, there's stocks that are so liquid, it's ridiculous. So that's really not an issue unless you're looking for that type of stuff. In my opinion, most people don't really kind of like do enough research to find illiquid trades. Because the trades, a lot of times they're going to jump out in front of people, going to be very liquid. They're not going to be illiquid. You got to look for illiquid trades. Like most people don't know about Avis because they don't look. Yeah, volume on equities. That's what I mean. So when I'm looking at volume on the overall ticker, I'm looking at what's the volume on the daily trading. What's the daily trading volume? But again, most people won't find illiquid tickers because normally to find an illiquid ticker, you got to really be looking at tickers a lot. Most of the tickers that are going to trend or they're going to be in people's faces that the media is going to talk about, they're going to be very, very liquid. Why do they want it that way? Because they want you to buy so they can get out. So they're going to hype it up. They rarely talk about an illiquid trader in the media. That's rare that they talk about a ticker that doesn't have a lot of liquidity attached to it in the financial media, right? It's just rare. Unless you listen to like short reports, but you know, the mainstream news or the journal, anybody, they mostly gonna just put liquid tickers in front of you. So Pascal says FinViz bar charts guru focus. Yeah, I'm on FinViz a lot. I know bar charts too, but FinViz got great search options, so you can just look at tickers all day. So we got any other questions before we get up on out of here? I appreciate everybody for coming through. Oh, Light, forgot to add this. You said, did the movement or how did I trade Avis with such small open interest? Does the movement or direction you get make up for that? Okay, so let me answer that again because I was thinking about that. Yeah, so the spreads is wide too. So yes, the volatility made up for it. So because the trade was so volatile, it made up for it. But if the spreads was tighter, I could have made more money. That's the reality of the situation. So yeah, so small open interest, tight, wide spreads, the volatility made up for it. But if I could have, if it would, the spreads would have been tighter, like 10 cents, 15% cents in between the spreads, I could have made way more money than what I currently made on the trades. So that's just how it is, right? So that's just a sacrifice I had to make on that particular trade. So that's a great question. That's why I came back to it. That's a great question. So yeah, that's just something. So now here's the downside. If the trade would have went against me, I would have lost a lot of money trying to get out of the trade. So that's why I tell people like that type of stuff is not for it's not for amateurs, because you got to know going in, if this thing doesn't go the way I want it to go, I can lose a lot of money trying to get out of the trade because it's not very liquid. Right. So that's why I came back. That's a great question. So yeah, but looking at the chart, it sold off from earnings and just kept selling. And it's like I think it gapped down on the open the day after earnings and it just kept going down. But yeah, so it was a volatility in the direction that I wanted to go into, but it was a higher risk trade because of low open interest and wider spreads. Right. And so that's the issue. So even me exiting on profit, that 300% probably could have been 500% with a tighter spread. You see what I'm saying? And the 64% probably could have been 100% with a tighter spread. But there's not a lot of activity on the chain. See, so there's not a lot of people in that market. So I'm really, the market maker don't have an incentive to execute me at a certain price because I'm either take the price or leave it. Right. So that's the issue. So that's why I tell people, like, that's to me as a pro play. I would encourage anybody that hasn't been trading an extensive period of time to trade that type of ticker. But that's a great question. That's why I came back to it. I realized that second part of it. So yeah, the volatility made up for it. But that's a great question, L Light, which you normally got great questions. So I appreciate you coming through. So Cedric Webb says, I'm assuming there would be key performance indicators and that indicate the direction of the company. I'm not sure. So you would have to define what your key performance indicators are. So Mr. Webb, what I would encourage you to do is to come up with definitions for what you're looking for, as opposed to using like ambiguous terms, right? So if you ever see me lay out a narrative around the company, I'm very specific for what I'm looking for. It's nothing ambiguous. So my trading narrative is very, very specific. I listen to a young woman that makes a lot of money in this market. Like, she makes a lot. Young chick makes a lot. And I bought one of her live streams, right? And one thing that she did was when she came out, she explained in detail what her market bias is. There was nothing ambiguous about it. And then she trades off that market bias, right? There's no ambiguity. So what I really would encourage you to do is to come up with something that's really specific around what you think your KPIs are, because your KPIs can be whatever, but I would just encourage them to be specific so that you can create a model based around that, because they can just be whatever, right? What's going on, Miss Martin? Do I look at unusual activity? You got to define what unusual activity is. So again, we got to get out of the ambiguity and define what it is. So when I teach about open interest, I give them a number of what I'm looking for in open interest normally under normal circumstances. This is what I consider a healthy market for the contracts. It's a specific number. It's rarely an ambiguous term because that don't mean anything. So how do we define unusual activity? How is it defined? So then once I know how I define it, then I know what I'm looking at. So I don't know how you define unusual activity. How do you define the activity to be unusual? What's your definition of it? Because it can be unusual to me, but be normal to you. Or you could think it's unusual because I watch that ticker all the time. I know that that's not really unusual. Right? So I know what they're selling in the market is unusual activity. You know, it is what it is. Based on how market functions, do I think crypto will take away from the market in certain sectors or just be another investment vehicle? I think it's a wait and see. I think we got to wait and see. Do I think the market continues to move higher after the election? I think the election don't have anything to do with the market moving higher. I think the market moves higher because that's what it's designed to do. That's what I think it does. I don't think the election is going to have any impact. I don't think the election is going to make it move higher. I think they don't want the market to go down during an election, but I think the market will move higher if this wasn't an election year. That's what it's designed to do. It's designed to go higher, right? It's not designed to trade down or even to really trade sideways. It's designed to go higher because they want to influence people to put more money in the market. And the way they do that is they make the market keep going up. Why would I put my money in the market if it's just going to trade flat? The market got to go up. I can put my money in the bank and do that and not have any risk to my capital. So I need the market to go up to justify the risk to my capital. In my opinion, that's my market bias. So yeah, the market's going to go up regardless of who's the president, regardless of the election, no election. Only thing probably stop the market from going up is if aliens come out of space. That'll probably kill the market. We got any other questions before we get out of here? So whose live stream did you purchase and follow? I mean, do you know it? I'm not trying to be disrespectful, but I don't think it's not like somebody that's big on social media. You know what I'm saying? So I don't know if you'll be able to find her, but email me and I give you her name. But it's not like, this is not a social media person. You know, this is just a person that I know through some other people that makes a lot of money trading, but it's not like a social media person that makes a whole bunch of YouTube videos. It's not that type of person. They just get money out of the market. That's the thing. So they email me. My email's on my YouTube, and I'll give you the name of the person. But I don't want to be yelling their name out like that because they're not big on social like that, especially on YouTube, because they don't want to be big on social media like that. So I just don't want to be yelling their name out. How's my journey been in finding another broker? It's going good. It's not even been an issue. So I think I went to TD Ameritrade, which turned into Schwab. So that hasn't been an issue. Right? I need to find a Forex broker. That's what I need to find next. Okay, good. So that's the 1 hour mark. Appreciate everybody for coming through. Hit me up in the comments. Stay safe. Talk to you later.